I wouldn't argue the danger is non-existent, but more that these centralized institutions already have hundreds of thousands of coins. There are more than that, even when you include Coinbase, but they remain in the minority. So only a small fraction of coins are held by huge centralized institutions. While this could lead to a little rise in their holdings, it won't be enough to change anything. After all, if you weren't concerned about 15% of coins held by major organizations, then 20% probably won't. More precisely, 600,000 coins in exchange-traded funds ETFs that aim to reach 1 million or 1 billion plus 2, correct? It's not that that makes a difference. Major Wall Street firms like BlackRock already own enormous amounts of Bitcoin, and the advent of spot Bitcoin ETFs has caused a schism among Bitcoin investors. Many investors have been increasingly worried about BlackRock's abrupt and unexpected foray into Bitcoin since last year. The recent legalization of exchange-traded funds ETFs has brought greater focus to the hazards involved, as shown by the dramatic increase in Bitcoin purchases. As of February 27th, the IBIT fund's assets have increased significantly to 141,142 Bitcoin, according to data from BlackRock's website. This represents a doubling of holdings compared to January 31st, when they were 66,800 Bitcoin. Various measures continue to show that BlackRock's spot Bitcoin ETF is the market leader. Tuesday saw a record-breaking $1.36 billion in trade volume and $52.2 million in inflows for IBIT, the platform's largest day total to date. This influx of capital outpaced the combined net inflows of all spot Bitcoin ETFs the day before, which came to $19.8 million and broke the record established 5 days before by 5%. On the other hand, Bitwise SPB brought in $18.4 million, while Fidelity's FBTC ETF brought in $126 million, placing it in second place. Lyn Alden, a well-known macro analyst and investment strategist, is unconcerned about the influence of Wall Street through ETFs, even though demand for these products is increasing. Alden says that people like Charles Hoskinson and Max Kaiser, who are involved with Cardano, are overstating the dangers of these goods. Even if the Winklevoss twins' initial proposal for a Bitcoin ETF was a positive development, I believe that would have been a bigger deal a decade ago. It was reasonable of them to do that, you know? It was early on in the life of this asset. On the other hand, it's easy to see how many Bitcoins would have ended up in exchange-traded funds ETFs if that had occurred. Bitcoins thankfully have had 15 years to sort of disperse. As a result, returning a large number of coins to a centralized custody system is a daunting task. With GBTC, there were over 600,000 coins in a trust, essentially an ETF for the sake of this discussion, rather than an ETF itself. Thus, even if you increase the amount to 700,000, 800,000, 900,000, or 1 million, you are still dealing with 5% of coins. Additionally, the higher you go, the more likely it is that price will reflect it. Gaining a larger portion of the network becomes more challenging as a result. You can increase the monetary value, but the value of the network is growing, so I don't think you can keep putting more and more of the network into exchange-traded funds. Because there has been pent-up demand for Bitcoin for a long time. And because there are controlled walled garden capital firms that are interested in buying some, I believe that number and percentage will rise at some point. Thus, I believe it begins to decelerate once that demand is satisfied. The main concern is less with transaction filtering and similar issues because it is a proof-of-work network instead of a proof-of-stake network. The most important thing would be to figure out who comes out on top in a hard fork or when large owners have an impact on it. A push occurs in the economy. If you weren't already concerned about large organizations holding 15% of the coins, then 20% probably won't alter anything, will it? Alternatively, 600,000 coins in exchange-traded funds ETFs that aim to reach 1 million or 1 billion plus 2, correct? It's not that that makes a difference. That risk is, in my opinion, exaggerated. The fact that there are exchange-traded funds ETFs on Bitcoin means that it is no longer considered cypherpunk money, according to some of the no-coin or TradFi proponents. However, that is an absurd argument because Bitcoin itself did not choose to include ETFs, not like the Bitcoin committee just sat down and decided to launch ETFs. You won't find a Bitcoin Council or committee anywhere. Bitcoin is merely a protocol that is open source. Now, TradFi has chosen to incorporate parts of it into its own system by building on top of it. For programmers, the ETF is essentially the fiat system's application programming interface. It merely improves the compatibility of the fiat system with Bitcoin. That is their sole function. Though it affects the price of Bitcoin more than the price of TradFi this cycle, it is still an improvement to the TradFi system and not a Bitcoin update. The fact that Bitcoin has other more cypherpunk applications remains unaffected by this though, correct? We may safely assume that our parents do not currently have a cypherpunk need, even if they do own Bitcoin in an ETF. So that's cool with them? On the other hand, I believe that privacy will likely remain a central point of contention. Therefore, Bitcoin has effectively won the struggle for legitimacy. The energy argument is beginning to shift, in my opinion, because of this. The idea that Bitcoin will drain the world's energy supply and degrade our oceans has, a lot of valid criticism. As for the narrative and grid balancing, there is a lot of resistance to the idea that it is motivated to use the world's cheapest edge electricity that is largely unused and that it relies heavily on stranded energy. I see. The media and academic institutions are beginning to cover that. However, protecting people's privacy is, in my opinion, the most pressing issue. In the short run, I believe it's oversold since, for example, there is no clear relationship between the halving and the price activity over the past 3 months. It is not uncommon for the bull market to have begun before the halving begins. After a market halving, a bull market may occur. It's a negligible fraction of the total volume. The impact of a shift in demand can be even more significant. In my opinion, the halving becomes significant when considering the bigger picture. The price of Bitcoin would be far lower if it did not experience more disinflation over time. It would be fantastic if each block still produced 50 coins. To absorb the amount of trouble that's on the way, you'd need a substantially lower price. Therefore, it is unquestionably pertinent, and I believe the most important issue is that at the halving, when there is no new marginal demand for Bitcoin, some buyers are moving out of the market. This happens during every bear market, and it's a big deal. As the price drops, hodlers can acquire more coins since they can essentially consume the supply. There are fewer coins being released into circulation presently compared to previous cycles. If you want a larger price floor during bad markets, it is highly important. In my opinion, the narrative timing is a bit excessive, but it doesn't diminish the significance. In my opinion, this still has a moderate impact on the timing. I simply believe that overall global liquidity indicators are more closely tied to the price of Bitcoin. This makes sense, considering that the halving only affects the annual issuance of a couple of $1 billion at current prices, while changes in demand can affect the influx or outflow of hundreds of billions of dollars a year. One example is how important I consider that aspect to be when considering timing. However, I believe the halving to be of paramount importance. It's also crucial for story. For each cycle, it's crucial for the higher peaks and lower troughs. I noticed that one of the images in your background resembles a hollow wave chart. Basically, if the price goes up enough, the supply becomes a lot more readily available, which is what happens when a lot of coins with longer-term holdings come to market. Since it is difficult to determine when this kind of reaches its zenith, that might signal the beginning or perhaps the conclusion of a cycle. However, when that ratio drops significantly, the risk of word becomes noticeably worse within any 1-2 year period. There has been a significant decline. The market is seeing a flood of fresh coins. A craze has developed in the most recent cycle. For example, I've witnessed the vertical rise of Dogecoin during periods of widespread hysteria, because of course Bitcoin has a fixed supply and there is a great deal of demand. As I mentioned before, older coins unlocking and offering their coins for $250,000 is one example of how supply can emerge to meet demand when demand becomes highly diffuse. I see. And so it goes with the introduction of new coins to the market, people start to wonder, what else can I buy? This coin is appealing to me. This coin is appealing to me. The purchase of this JPEG is something I am interested in. Please sell me this. I am interested in purchasing shares of this overpriced blockchain XYZ's company. I see. There is an endless supply of random items that can keep making its way to market to satisfy need. Therefore, it's all about fulfilling demand. Saturation of that cycle's demand is thus becoming an increasingly real possibility. After that, there's a bust and people lose faith. At the top, they purchase them. The money was bought at the top, but it's a little late. After that, you eliminate the surplus by going through a shakeout cycle. And so, in reality, it's probably not that different between Bitcoin and other things when you combine the hodl wave going down or other metrics of tightly held coins coming to market with a flurry of other low-quality things trying to meet the overall demand for capital that wants to enter the space.